So this is the US dollar or euro US dollar, and we're looking at the moment at a monthly chart. This is just, we want to start with a longer time frame and then gradually move in, and let's go back into the weekly chart. So what we can clearly see is, even if we go back here, let's just go a little bit further back to our monthly chart. We can clearly see that this is your sort of resistance area for the euro US dollar, and this support is a pretty solid support because it's bounced off here again. If we go back into the weekly chart, we can clearly see that actually this low here was lower, slightly lower than this high over here. So sorry, this high here was slightly lower than this high, and subsequently that this euro was sold off as the dollar gained strength. And as we go down further into like the 4-day, 3-day chart, you start to see different things. For example, if you've been through the full course on trading, you'll see that we have a wedge or ascending triangles in here. We have channels. This is a channel, clear channel over here. We have let's just see it here. We also have sort of a flags, and you can see these channels, they sort of run in most places. So this is the euro US dollar on this time frame. So if we go over here, let's go to the daily chart. So from this short swing trade, we can see that this is in a slight uptrend going back. Let's see. So at the moment this has gone into an uptrend. You can see it was in a downtrend here from the daily time perspective. I'm not talking about the weeklies or monthlies, but you can clearly see here that this goes back to our previous discussion, that whenever any stock Forex is below the 200-day moving average, below the 50-day moving average, you can always see that particular pattern, price pair, or whatever you want to call it, move down. It's just something about the 50-day and the 200-day, and the main reason is your institutional investors and hedge funds are using these moving averages more than your retail investors who would just get in and out the market. And as you can see over here, the Forex pair, the euro, moves into a downtrend, and what you basically see is it breaks through the 20-day, the 10-day. Actually, this is a 6-day moving average, so it breaks down through the 6-day moving average, through the 20-day moving average, and your 50 days below your 200-day. And what you always find is that pair will always gravitate like a magnet and test the 50-day moving average once or twice. If it fails to break through that again, you can always expect quite a deep retracement. And you can test this pattern out going back 100 years. This pattern is evident over and over again. So you can see that so far that back in May 2012 it came down, and back in August we started this uptrend. So on a daily chart, if you were a daily trader, for example, daily traders have to be more patient because these markets move in trending motions all the time. But nonetheless, let's say you got into the market here, which is back Tuesday the 21st of August, I believe that was 21st of August. If you look to the right hand side of my crosshair, this is called a crosshair, that I'm moving to the far right hand side, you can see if you got in according to our parameters, which is once the pair moved above the 50-day moving average, once it moved above the Bollinger Bands, the 6-day moving average, and the 20-day moving average, which is this sort of purpley line over here, you could have made, so remember that figure there, 2364, and let's say you even got in over here, 2364. So remember that 2364 3107 minus let's say you got in over here, because this was a pretty good move that would have pulled you in 2337. you can see there's 770 pips you would have made there. Now that is just on a daily chart. As you can see on these green candles, if you had gone on to the intraday basis, you would have actually been able to pull profits out the market as well. So with your one standard lot, that basically would have been 7,700 US dollars. So that's how much that trade would have been worth. And as you can see there, I drew this back in December. This actual pattern in here, we had like an ascending triangle. We had lower highs, we had lower lows, and as you can see here, we discussed in the previous class of price patterns, we have a double bottom here. Now, a double bottom usually occurs in a downtrend, but as you can see here, we do have a double bottom. One bottom, two bottom, it comes back up, fails the top, comes back down. So maybe not a textbook example of a double bottom, but nonetheless, you can clearly see here. Basically, what's important is that this candle here failed to take out, or the very next candle failed to take out the previous high, and then we have a move to the downside, right? But once this had moved to the downside, I mean, if you were a short-term trader, even a day trader, you would have caught this move here, which would have easily been a 100 pip move, right? Almost a 100 pip move, $1,000 in a very short time span. And then what we have is that the pairs moved up even higher. So you can see here, once again, we get into sort of an ascending triangle on a larger time frame, because these patterns are fractal in nature. The Forex market is fractal in nature. What works on a 5, 10, 15, 20 minute time frame, these patterns work on any time frame, any market. It's just we're not looking at the market, we're looking at price patterns. So now let me jump into the 4-hour chart, which is my preferred chart. And as you can see here, every time it's gone above the 50-day moving average, if you bought it as it was crossing the 50-day moving average, you would have made money. That's just a given. Obviously, I'm not telling you to trade in the markets. I think education is the #1 key factor that's going to make a difference. So as you can see, crosses the 20, crosses the 50, it goes down. There's no single case of it ever doing the opposite. And as you can see here, crosses the 6, crosses the 20, it's above the Bollinger Band, crosses the 50, and away off we go to the races. So this is just looking at the Euro US dollar now, and today's date is the you can see we are in February 2013. Now the good thing is here, I think it could retrace a bit, and unless it took out these previous lows here, would I think of going short. I could go short at the moment, RSI's here, but personally I think you're looking at a low there. If it breaks below that low, then yeah, sure, I'd be looking at your next targets down here, but until it does that, I'm still pretty long the market. The euro has run into a few issues recently, if you look at the news on that, your news feeds, as well as the dollar. But generally speaking, the dollar compared to some of the other pairs has been in a downtrend the past few weeks, or been selling off. So I think unless this breaks below this low, yeah, unless it crosses our Bollinger Band, I wouldn't just look to go short quite yet. I like to see it crossing below the 6 and then the 20, and for me that would be the perfect sell signal. But if I see MACD going down here in a pretty fast motion, then I would be looking to turn around and sell the euro instead of buying the euro. So hopefully you can start seeing some more of these patterns. I aim to make sort of a one analysis per week of what's happened in the market, and have a look at some of the other Forex training videos, because they explain a lot, especially in the beginner course. And if you're really looking to make money in the Forex market, you need to be watching the market on a continual basis, at least once a day or twice a day, depending on your time frame. This is a business like any other business, and you can trade 24 hours during the week. So hopefully you've enjoyed this, and keep an eye out for the next course.